Today, we are diving straight into a huge story that's rocking the currency markets. The Japanese yen has absolutely tumbled, and the big question everyone is asking is, what on earth does this mean for the Bank of Japan? Is that rate hike we all expected now completely off the table? Let's get into it.
So the number of the day, the number we all need to be watching is 153. That's the critical level the yen has just hit against the US dollar. We're talking a multi-decade low here, and it's got traders everywhere on high alert. You see, this isn't just a number, it's a huge signal that something fundamental has shifted in the market. So what is going on behind this sudden slide?
And wow, this chart right here really shows you just how sharp and sudden this move has been. We're seeing a pretty serious depreciation that brings up two really important questions. First, why is this all happening right now? And second, what is this signal for the rest of the global financial markets? Let's start digging for some clues.
To solve this puzzle, we've got to start by looking at the evidence coming directly out of Japan. It turns out there are a couple of key economic reports and maybe a little political maneuvering that have totally flipped the market's perspective on its head.
Okay, clue number one was Japan's fourth quarter GDP data. Now, the market was forecasting a pretty solid 0.6% growth, but the actual number? It came in at a really sluggish 0.2%. That huge gap between what was expected and what actually happened was a massive disappointment, and it immediately made people doubt the strength of Japan's economy.
Now, the second clue was a bit more political. There was a high-level meeting between the Bank of Japan Governor Ueda and Prime Minister Takaichi, and it sent some serious ripples through the market. Now, the official statements were, pretty vague, but the meeting basically poured ice-cold water on any expectation of a rate hike happening soon. That's led to a lot of speculation that maybe, just maybe, some political pressure is being applied to delay any tightening.
So how did the markets react to all this? Well, they reacted instantly. Just look at the Japanese bond market. It's incredibly sensitive to interest rate expectations. We saw 5-year government bond yields drop sharply, as you can see right here. This is a clear sign that traders were aggressively backing away from their bets on a near-term policy change from the Bank of Japan.
And here's the bottom line. You take that weak GDP data, you add in the political signals, and you get a dramatic shift in expectations. I mean, just a week ago, the swap markets were pricing in a nearly 80% chance of a rate hike by April. Now, that probability has absolutely plummeted, down to just 65%.
But hey, the story of the dollar-yen is always a tale of two different economies, right? So now we need to pivot, hop across the Pacific, and take a look at the other side of this currency pair, the US dollar and the powerhouse economy that's backing it.
And well, the situation in the US could not be more different. We're looking at a picture of remarkable resilience. The underlying growth is just humming along between 2 and 3%, the labor market is still really strong, and even though headline inflation has cooled off a bit, those core numbers are stubbornly sticky right around 3%.
So what does all this strong data mean for the US central bank? Well, it gives the Federal Reserve pretty much zero reason to rush into cutting interest rates. They can really afford to be patient here, putting them in what a lot of people are calling a period of pause while they wait to make sure inflation is truly beaten before they make any moves.
Okay, so we've got a hesitant Bank of Japan on one side and a patient Federal Reserve on the other. Now let's connect these global dots to really understand exactly why the yen is under so much pressure. This right here is the absolute heart of the matter. The yen slump is a direct result of what we're calling the Great Policy Divergence. The Bank of Japan is delaying its planned rate hike because its economy is weak. At the same time, the Federal Reserve is putting its rate cuts on hold because inflation is still sticky. This widening gap in interest rates just makes holding dollars way more attractive than holding yen. It's as simple as that.
And this whole divergence thing isn't just hitting currencies, it's creating a pretty cautious tone across all markets. For instance, during what was supposed to be a quiet holiday trading session in the US, we actually saw equity futures pointing lower. This suggests that investors are kind of taking a step back, getting a bit more defensive as they process these shifting central bank outlooks.
So now that we understand the why behind all this, let's turn to the what's next. To stay ahead of this story, there are several key economic events coming up that could give us our next big set of clues. All right, looking at the economic calendar from investing.com, the week ahead is absolutely packed. On Wednesday, we're going to get the minutes from the Fed's last meeting, which should give us some great insight into their thinking. Then on Friday, all eyes, and I mean all eyes, are going to be on the core PCE data. This is the Fed's favorite inflation gauge, so that number is going to be a massive piece of the puzzle for whatever they decide to do next. And that all leads us to our final and pretty provocative question. With this policy gap between the US and Japan looking like it's only going to get wider, the pressure on the yen could become really intense. So, will the Bank of Japan be forced to jump into the market and directly intervene to stop its currency from sliding further? That is the billion-dollar question that traders are asking themselves right now.
This explainer was automatically generated by NotebookLM, an AI-powered tool. The reference sources we used in this summary are listed in the description. Because this content is AI-generated, there might be some errors. This content doesn't provide investment or trading advice, so please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.